Hey everyone, I have an important S&P 500 update for you here that I'd like to share with you. Before we get to that, I do have one favor to ask, and I typically don't ask for favors. What we're doing here at thesteadytrader.com is to provide education about the markets, because I truly believe there's a lot of misinformation and just bad education, if you can call it that, even being spewed out there by people with really no experience in the market. So one favor I have is please go to our YouTube channel. It's youtube.com/ at the Steady Trader. So just go to at the Steady Trader, or if you're watching this on YouTube, right here, please subscribe. Very important, please subscribe to our YouTube channel. We're just about to crack the 5,000 mark. We want to make sure we get this to 10,000 as quickly as possible to really help people on their investment and trading journey, because it has changed now. Markets have changed over the past few months. It's been in progress now for about almost 12 months. But I think now people are kind of waking up to it a bit more. So please go ahead, subscribe to our YouTube channel, give us a thumbs up, like as well in this video. And here we go. Let's talk about the S&P 500. Well, unless you've been hiding under a rock, or maybe just not watching markets as much, you have probably noticed that we have had a bit more of a difficult time this year. Well advertised in our part that we would expect this in US equities. The S&P 500 essentially had a drawdown from its February peak down to its trough, or so far trough at least, or lows in April, to the tune of just about roughly 20%, and we've rebounded since. Here is one way of looking at it, and this is an S&P 500 centric analysis, but I do think it helps people kind of risk manage. So that's really the purpose of this short video. When we started breaking for the S&P, and I'm looking at the SPY ETF as a proxy to the S&P 500, when we started breaking below 550 or so on a tariff day, we basically had sort of a crescendo. Fear started really coming into the market, and from that level down lower, it was in about another sort of 10 to 11% of a sort of free fall. We then got very oversold ratings. Our members were able to start playing for the bounce, but we're now getting into this area where, if you look at it closely, it says next resistance area, which is this next level up here. And this level is not this area, it's an area, it's not arbitrary. It's basically, if you look at it, it is exactly where we started to see people basically chase the market, the S&P 500, after the election results. And we think anywhere between, in SPY terms, anywhere between more or less here, call it 550, all the way up to about 580. So 5,500 to about 5,800 in S&P 500 terms is fair game for resistance. Now that's a wide range, that's 5% wide. But if you think about the volatility we have, the VIX, got up to almost 60, I believe it was, during that sell-off. VIX remains rather high, or elevated, I guess. And so a 5% range is really not abnormal. That's very much par for the course as far as a range is given. So in our view, educationally speaking here, not advice, this is probably a good spot to start thinking about maybe lightening up on any S&P centric allocation, particularly as it relates to sort of the higher octane technology stocks, even Max 7, if one is dramatically overweight. I'm not saying anyone to sell all those stocks, that doesn't make sense, but if one hasn't done so yet, and we know most people have not, by the way, it's something that, through the lens of education here, something worth exploring. Now, here's the real reason why this is important. You have to think about this through the lens of psychology, why I am highlighting this area. It's because we have a lot of what's called trapped buyers that were either forced to buy, or were buying because of FOMO, or fear of missing out, after the US election results. And so those buyers are probably somewhere north of that area, maybe as low as 570 to maybe 580 and above. That's the area where there's a lot of trapped buyers. Those are the people that, you know, when it was all about only US stocks and only US stocks forever, when those people basically chased, they were met within a few short months with a pretty gnarly drawdown of 20%. Through the lens of psychology, what tends to happen is that when those people, after that shock, and they didn't sell yet, we know factually almost no one has really sold except for pension funds rebalancing and hedge funds, of course, which are much quicker. For the most part, the people that are sort of that chased up, they haven't sold. But they're going to start considering selling once we start getting into this area, which we're now getting into. So that's why I think there's a lot of resistance up here that we could get into, and trapped buyers will be able to kind of get out relatively unscathed from there, which basically means there's going to be a lot of overhead supply coming to the market. So that's one way of looking at it. Again, please make sure you subscribe to our YouTube channel. It really would help us out a lot to get above that 5,000 mark, and then hopefully on our way to 10,000, and hopefully much more. So just if you're watching this on YouTube, again, subscribe, give us a thumbs up, like, and a lot of goodies with that as well, because it allows you to be able to watch our Set the Market morning show, which we do live. It's our morning call, live analysis every morning, 10-15 minutes of the market, our top 3 things that we're looking at Monday through Thursday. If you subscribe to the channel, which of course is free, you'll be able to be alerted every morning when we go live Monday through Thursday. See you guys in Set the Market, our live morning show, and thanks for subscribing.